The Global Market Deep Dive today. This is Eric. What's up, everyone? Welcome back to Market Meridian. If you're looking at your portfolio today and feeling a little punch drunk, you're definitely not alone. March 3rd was a reality check for the bulls, no ifs, ands, or buts about it. The Goldilocks narrative, that perfect fairy tale of cooling inflation, steady economic growth, and guaranteed Fed rate cuts by mid-year, it just hit a massive brick wall called geopolitics. And let me tell you, that wall didn't budge, it knocked the wind right out of the market sails. The lead story today? Pure, unadulterated risk-off sentiment, no sugarcoating it. We saw the S&P 500 drop nearly 1.2% and the Nasdaq slide over 1.5% as Middle East tensions boiled over overnight. Reports of escalated strikes in key oil-producing regions sent shockwaves through the markets, and this wasn't just a minor dip or a blip on the radar. It felt like the last straw for investors who were already sitting on massive gains from the January-February rally. The flight to safety was real, it was fast, and it was unforgiving. We're talking about a massive rotation out of high-flying growth stocks, think AI, tech, and speculative plays, and right into the arms of the US dollar, the ultimate safe haven when the world feels shaky. Let's look at the scoreboard, because numbers don't lie. The DXY, the dollar index, is flexing its muscles again, reclaiming that key 104 resistance level we've been watching for weeks. That's a big win for dollar bulls, and it's putting pressure on every asset that's priced in greenbacks. Crude oil? It's surging over 2% today, topping $82 a barrel, and honestly, that's no surprise. Whenever the Strait of Hormuz is in the headlines, when supply chains for the world's most critical energy source are at risk, the energy bulls come out to play, and everyone else holds their breath. And Bitcoin? Man, the digital gold crowd took a hit today. BTC dropped over 3% in early trading, and here's the kicker, it didn't act like a hedge. It acted like a high-beta tech stock on steroids, moving in lockstep with the Nasdaq instead of decoupling. We're going to break all of that down, why the dollar is winning, why oil is spiking, and why Bitcoin failed to live up to its hype today. Right after this quick reminder, hit that like button if you're following along, and drop a comment below, did you see this sell-off coming? Alright, let's circle back to that risk-off move, because it's not just about geopolitics, there's more to the story. Investors were already on edge heading into this week, thanks to last Friday's PCE inflation data, which came in slightly hotter than expected. That already put a dent in the rate cut in March narrative, but add in geopolitical chaos, and you've got a perfect storm. Let's talk about positioning. Hedge funds had been piling into growth stocks and crypto, betting on that Goldilocks scenario, but today, they're hitting the sell button fast to lock in profits before things get worse. Retail investors? A lot of them are sitting on the sidelines, scared to buy the dip because they remember 2022, when every dip turned into a bigger drop. This isn't panic selling yet, but it's close. The key difference? Volume. Today's trading volume is up 15% from the 20-day average, which means big money is moving, and that's a signal you can't ignore. Before we move on to part 2, let's recap the first 8 minutes, because context is everything. March 3rd was a wake-up call, the Goldilocks narrative is dead, geopolitics is back in the driver's seat, the dollar is strengthening, oil is spiking, and tech is starting to crack. This isn't a one-day event, this is the market re-evaluating risk, and that's going to take time. In the next segment, we're diving into big tech, why the AI summer is feeling like a late spring chill, and what the 50-day moving average means for the S&P 500. Stick around, because the next 10 minutes are going to be critical for your portfolio. Alright, we're now diving into the belly of the beast, big tech. For months, we've been calling this the AI summer, Nvidia hitting all-time highs, AMD crushing earnings, Apple and Microsoft riding the AI wave, but today? Today felt like a sudden late spring chill, and it's got everyone asking, is the tech rally over? Let's cut to the chase. Nvidia is down 2.3%, AMD is off 1.8%, Apple is down 1.1%, and Microsoft is sliding 0.9%. The heavy hitters are all under pressure, and it's not just because of geopolitics, there's a fundamental logic here, guys, and you need to understand it. The culprit? Valuation logic. When geopolitical risk spikes, investors start worrying about growth slowing down, and when that happens, the 10-year Treasury yield starts acting crazy. Today, the 10-year jumped to 4.28%, its highest level in 2 weeks. Why does that matter? Because high multiple growth stocks, like Nvidia, which trades at over 40 times forward earnings, are priced on the expectation of future profits. When yields go up, the present value of those future profits goes down. It's basic finance, but it's easy to forget when the market is rallying. So, when the 10-year spikes, those high-flying tech stocks get squeezed, and that's exactly what we're seeing today. If you're tracking the charts with me either on your phone, your laptop, or your trading screen, keep your eyes on the S&P 500's 50-day moving average. Right now, we are testing it. That line, around 4,850, is the line in the sand. It's the average price of the S&P 500 over the last 50 days, and it's been a key support level since January. If we close below this tomorrow, we aren't just talking about a pullback anymore, we're looking at a potential midterm correction, maybe 5% to 10% down from recent highs. Then buy the dipped crowd, which has been so active over the last few months, is hesitating, and that's a signal you cannot ignore. Why? Because when the dip buyers step back, it means confidence is fading, and that's when sell-offs can accelerate. Now, let's talk about rotation, because when one sector bleeds, another one usually benefits. While tech was bleeding today, we saw some storm sellers popping up in utilities and healthcare. Utilities are up 0.7% today, and healthcare is flat. Those might not sound like big gains, but in a market that's down over 1%, flat is a win. It's the classic defensive playbook. Investors are hiding in stocks that pay steady dividends, have stable cash flows, and sell stuff people need regardless of whether there's a conflict in the Middle East or a recession on the horizon. Think about it, people still need electricity, they still need medicine, they still need healthcare, those are non-negotiables. It's a boring trade, sure, but in a market like this, boring is beautiful. Boring keeps your portfolio safe when everything else is volatile. Before we move on to part 3, let's wrap up this segment. Big tech is under pressure because of rising yields and valuation concerns. The S&P 500 is testing a critical support level, and investors are rotating into defensive sectors. This isn't the end of the tech rally necessarily, but it's a warning sign. If yields keep rising and geopolitical tensions don't ease, tech could face more pain. In the next segment, we're talking about commodities, specifically oil, and why it's the inflation poison that could trap the Federal Reserve. Stick around, because what happens with oil next will determine whether we get rate cuts this year or not. And it's time to talk about the elephant in the room, oil. Not just any oil, WTI crude, Brent crude, the stuff that powers the global economy. Today, WTI is spiking over 2%, topping $82 a barrel, and Brent is closing in on $87. But here's the thing, this isn't just a regular spike. When oil moves like this, especially in a market where inflation is still sticky, it's inflation poison. And that poison could derail everything the Federal Reserve is trying to do, specifically, cut interest rates. Let's break this down. The Fed wants to cut rates, they really do. Jerome Powell and his team have been hinting at rate cuts this year, with markets pricing in a 60% chance of a cut in June. But here's the catch, the Fed's number one goal is to get inflation down to 2%, and oil is a key driver of inflation. When oil prices rise, it pushes up the cost of gasoline, diesel, jet fuel, all of which feed into transportation costs. Those transportation costs get passed on to consumers, higher prices for groceries, clothes, electronics, everything that has to be shipped. It also pushes up energy costs for businesses, which either eat those costs, hurting profits, or pass them on to consumers, pushing inflation higher. It's a vicious cycle, and it's exactly what the Fed is trying to avoid. So, the Fed is trapped. If energy costs stay sticky, if oil stays above $80 a barrel for the next few months, they can't cut rates. Because cutting rates when inflation is rising would be a mistake, it would let inflation get out of control again, like it did in 2021 to 2022. But if they don't cut rates, the economy could slow down. We're already seeing signs of weakness in the housing market, and consumer spending is starting to cool. So, what's the Fed going to do? That's the $64,000 question, and tomorrow's ADP report is going to be a massive catalyst. The ADP report measures private sector job growth, and if that number is too hot, if employers are still hiring like crazy while oil is climbing, then that higher for longer talk is coming back to haunt us. And let me tell you, higher for longer is the last thing this market wants to hear. Let's look beyond oil for a second. Other commodities are moving too. Gold is up 0.5% today, which makes sense, it's a classic safe haven. But unlike Bitcoin, gold is acting like a hedge, exactly what you'd expect when geopolitics is heating up. Copper, which is a bellwether for global economic growth, is down 0.3%. That's a warning sign that investors are worried about growth slowing down. So, we've got a split picture. Safe haven commodities, gold, oil, are up. Growth-sensitive commodities, copper, are down. That tells us the market is confused. It's worried about both inflation and a slowdown. That's a stagflationary signal, and it's not good for stocks. Recap of this segment: oil is the inflation poison that's trapping the Federation. If oil stays high, rate cuts are off the table. Tomorrow's ADP report will be critical. Hot jobs data plus high oil equals higher for longer. Gold is acting like a hedge, copper is signaling growth concerns, and the market is stuck between inflation fears and growth fears. In the next segment, we're talking about digital assets, Bitcoin versus the king dollar, and why BTC failed this stress test. Stay tuned, because this is going to be a controversial one. And talk about digital assets. Specifically, Bitcoin. I see the comments every day: BTC is the new gold, Bitcoin is a hedge against inflation, decouple from traditional markets. Well, today, the market said not so fast. When the chips were down, when geopolitics spiked, when stocks sold off, when investors were looking for safety, capital didn't flow into Satoshi's vision, it flowed into the greenback. The dollar index is reclaiming its throne as the ultimate liquidity destination, and Bitcoin. It got left in the dust. Let's be honest, Bitcoin failed this specific stress test. Why? Because when liquidity dries up, and it's drying up fast as the dollar strengthens, investors sell their riskiest assets first. And right now, Bitcoin is still seen as a risky asset, not a safe haven. Sure, it's called digital gold, but today, it traded like a high beta tech stock. It dropped 3% while gold rose 0.5%, that's not a hedge. That's a risk asset. The problem is that Bitcoin is still correlated to tech stocks, especially AI and growth plays. When tech sells off, Bitcoin sells off. Until that correlation breaks, it can't be a true hedge. And with the Bitcoin halving coming up in a few months, investors are starting to question, will the halving save BTC, or will the strong dollar and rising yields derail the rally? Let's shift gears to tomorrow, March 4th. What's the game plan? First, watch the ADP print like a hawk. The consensus is for 150,000 private sector jobs added. If we get a number above 200,000, that's hot. Expect the 10-year yield to spike, the dollar to strengthen, and tech and crypto to sell off. If we get a number below 100,000, that's cool. Expect a relief rally, with tech and crypto bouncing back. Second, watch the Fed speak. Several Fed officials are speaking tomorrow, including Neil Kashkari and Loretta Mester. If we hear even a hint of hawkishness, if they say we need to keep rates higher for longer, or inflation is still too high, the Nasdaq is going to feel more pain. If they sound dovish, if they hint at rate cuts later this year, we could see a bounce. My advice for tomorrow? Cash is a position. You don't have to be a hero in a volatile tape. If you're holding tech or crypto, consider trimming your positions, lock in some profits, reduce your risk. If you're looking to buy, wait for confirmation. Don't buy the dip just yet, wait until the S&P 500 holds above that 50-day moving average, or until oil starts to cool down. Defensive sectors, utilities, healthcare, consumer staples, are your friends right now. They won't give you massive gains, but they'll protect your portfolio when the market is volatile. And please bear in your mind, March 3rd was a wake-up call, geopolitics is back, tech is under pressure, oil is spiking, inflation poison, Bitcoin failed as a hedge, and tomorrow's ADP and Fed speak will be critical. At Market Meridian, we don't just talk about the noise, we focus on the logic more. We look at the data, we analyze the trends, and we make smart decisions, even when the market is crazy. Hit that subscribe button, turn on the notification bells, and drop a comment below. What's your move tomorrow? Are you buying, selling, or holding? That's it for today's Market Meridian, and we'll be back tomorrow to break down the ADP report and all the action. Remember, volatility is opportunity, but only if you're prepared. Stay safe, stay disciplined. All information and data in this video are not financial advice. Ask your financial experts before moving into any trade, and I'll see you in the next one. Bye for now. Please subscribe my channel.